Every week, the Payne family cuts straight to the real financial story.
The one question, Bob, everyone's asking is, are we in an artificial intelligence bubble? You've been through boom and bust. What do you think?
No hype, no myths. Just what actually matters to your money.
Does feel very similar to what we experienced in the 90s. Where are we, though? Are we in 1995, 1997, 1999?
Listen to the Pain Points of Wealth on the Red Apple Podcast Network.
The More Money Show with Steve Moore on the Red Apple Podcast Network.
Welcome back, folks. This is the More Money Show. This is a wonderful Saturday afternoon where we're celebrating an amazing military achievement that is bringing peace and prosperity and hopefully higher living standards to the people of Venezuela, and also defeating one of our enemies. This was also an act of preserving our national security, as Maduro was importing poison into this country and killing our young people. So proud to be an American today. But I want to switch gears a little bit and talk about the economy and investment opportunities in 2026 with somebody who's probably the world's expert on this, Rob Arnott. He's been on the show many times before. You know Rob Arnott. He's the founder of Research Affiliates. He's partnered up with Charles Schwab and Invesco and PIMCO, and is really considered one of the financial gurus of our country. So, Rob, thanks so much for coming on.
It's a privilege to come on, as always. Good to hear your voice.
You too. So I want to talk about 2026, and I'm getting all sorts of different reads on 2026, both with respect to what the economy will do, but also more importantly for a lot of people in terms of what will happen with the market. Before we get into 2026, give us assessment of what we saw, what went right and what went wrong in 2025 with respect to the markets.
Well, the biggest thing that went wrong in 2025 was the entire profession of professional economists.
I know. Well, watch it, Rob. I'm a professional economist. No, but you're exactly right. It's totally embarrassing how wrong they all were.
Yeah, the Fed employs more PhD economists than Harvard, MIT, and Yale combined. And they pay better, so they ostensibly get the best. Yeah. But here's a fun thought experiment. When the Fed makes decisions, they make them based on models for how the economy will react to their decisions. All right, how good are those models for forecasting GDP, inflation, unemployment, and interest rates? Both the Fed and the U.S. Treasury make these forecasts on a regular basis. They're pretty much useless beyond about a 3-month horizon. So if they're using these models to make forecasts, and the forecasts are useless, then how can their policy choices be any better?
Exactly.
We always hear the expression that monetary policy has long and variable lags. How do long and variable lags differ from we don't have a clue what our policy decisions will do or when? So
the question, Rob, sorry to interrupt, but you're precisely right. And by the way, just to add to what you just said, we have an economist here who's calculated that, their target inflation rate is 2%, as you know. And in the many months that we've had Jerome Powell as Fed chairman, they've only come within 10% of their target, like 10% of the time. Yeah. I mean, how do you screw up like that?
Coming within 10% of the target is a pretty tight target, but being over target 80% of the time is even more important. Right. Jerome Powell is beyond incompetent. He's inept. The poor guy doesn't have a clue. We should put him out of his career misery.
And by the way, again, sorry to interrupt you for a second, Rob, on this, but just for full disclosure, I remember Trump called me right before he made his Fed decision back in, when was that, 2017, 2018. And he said, what do you think of Jerome Powell? And I said, no, I wouldn't take him. I'd take John Taylor. I don't know if you know John Taylor. He's at Hoover.
I know John Taylor.
Great economist. I said, take Taylor. And one of the bad decisions that Donald Trump is by the way, every time I see him, Rob, and the first thing he says is, Steve, I was wrong about Jerome Powell. And I said, yes, sir, you were.
Yeah, he might have been good at investing, but he wasn't very good at managing the nation's money supply.
Yeah, that's
the
right.
other thing that's fascinating, and that Powell doesn't get, and in fact the entire neo-Keynesian economics profession doesn't get, is that stimulus doesn't stimulate.
Yes.
We did a study. People can look it up on SSRN. Yes. Entitled Does Fiscal Stimulus Stimulate? And we look back over the last 60 years.
Hold on again. Time out, Rob, time out. Just because I want you to define, a lot of people don't know, we have a non-economics audience. So what does fiscal stimulus mean? What does that even mean, fiscal stimulus? Fiscal stimulus
means borrowing money you don't have and spending it.
Yeah, okay. And the government's good at that.
So the government's extremely good at that, and there's bipartisan embrace of it. One of the areas where I disagree strongly with Trump is exactly that. We don't have the money to spend, so let's not spend it.
Right.
But in our study, we went back 60 years, and we found that there's not a single 5-year span in the last 60 years where there wasn't a negative correlation between how much a government was spending and how fast their economy grew all over the world. So we look at all of the OECD developed economies, all of them, and not a single 5-year span out of 60 years had a positive link between government spending and growth.
Hold on, time out. I want to make this really simple for our because you're making a very important point here, Rob. So what you're saying is because unfortunately, most of these Harvard and MIT and Yale economists believe in, hey, let's spend more government money and the economy will perform better. What you're saying, it's back asswards.
Yeah. Keynes himself would be excommunicated from the Church of Neo-Keynesianism. He believed he believed that in tough times it's okay to overspend because you're going to stimulate the economy, but then in the good times you underspend. You save money for a rainy day.
Right.
And boy, that is totally out the window. Yeah. So what we have is an overall embrace by the economics profession of something that's simply patently false. I think part of the reason for that is a really simple reason, and that is most of the economics profession now is paid by the government, so they want economists who will say government spending is good.
Yes.
And that's sad. So you have a whole takeover of the profession by government. So anyway, we looked back over the last 60 years and we found that the more government spends, the slower the economy grows. If you're spending less than 30% of GDP at the government level, growth averages 3 to 4% per person per annum. So with a growing population, it'd be 4, 5, 6%. If you're spending over 50% of GDP, as parts of Europe now do, your growth slows to about 1% of GDP. Now, 4% of GDP means that your economy more than doubles every generation. Your kids will be twice as rich as you.
Right.
So cool. Right. 1% a year means you have to wait 3 generations to double. So your great-grandkids will be twice as rich as you. Well, that's not all that exciting. So the economics profession has had a terrible miss. Stimulus does stimulate something. What it stimulates is corporate earnings, asset bubbles, and rising wealth inequality, all of which are the opposite of their claimed intent.
Exactly. By the way, I'm talking to Rob Arnott, who is a very, very famous financial expert. He runs research affiliates. And Rob, can I hold you over for another session? Because this is a fascinating conversation. We got to take a quick break, but are you okay to do one more?
Absolutely. Love it.
Okay. We'll be right back, folks. This is the More Money Show. We'll be right back with famous financial analyst Rob Arnott. We're back, folks. This is the More Money Show. Hope you're having a happy new year. And my guest, again, is Rob Arnott, who is with Research Affiliates, founded that great investment company. He's worked with Charles Schwab and Invesco and PIMCO, is really considered one of the most... by the way, I was reading your bio, Rob, and it says that you are famous for the, quote, Rob Arnott strategy, which has to do with how you allocate your investments. Can you tell our listeners about that?
Sure. It's called RAFI, Research Affiliates Fundamental Index. RAFI, basically the big indexes in the world choose stocks based on how valuable they are and weights them based on how valuable they are.
What does that mean, how valuable they are?
Market capitalization, the total value
their market
of the
cap.
stock
Okay, got
of
it.
a company.
Yes, right.
So, if a company is worth $5 trillion, it gets 5 times the weight of a company that's worth $1 trillion, which gets 10 times the weight of a company that's worth $100 billion, and so forth.
Got it.
And that makes intuitive sense. That's a very sensible way to do things, because you're going to wind up owning the market, which is cap weighted, and you're going to track the market, and you're going to be able to do that with negligible fees. But wait a minute.
Isn't that sort of like what an index fund does?
Exactly what an index fund does.
Okay, got it.
Index funds are all tied to these cap-weighted indexes. Now, think about it, though. If a stock doubles, your exposure to the stock doubles. You don't take profits. You wind up owning more of the stock after it doubled than before it doubled. Where is the sense in that? RAFI simply says, how big is the business, using multiple measures like what's the company's total sales or profits or book value or dividends plus buybacks, different financial measures of the economic footprint of the business. So RAFI then says, let's choose the 500 or the 1,000 largest businesses in the United States, and let's weight them by the size of their business. Now, what does that mean? That means NVIDIA, which is trading at 2 to 3 times the average valuation multiples of the stocks in the U.S., gets down-weighted. Well, why would you want to do that? NVIDIA is an amazing company. It is an amazing company, and it's been growing very fast, but that's reflected in the share price. In order to help your performance, NVIDIA has to beat lofty expectations. In order to hurt your performance, ExxonMobil have to underperform bleak expectations. So RAFI says, okay, ExxonMobil's still a bigger company than NVIDIA, so it gets a bigger weight. And, oh, by the way, if ExxonMobil tanks, then RAFI will say, thanks for the deep discount. I'm going to top it up. If NVIDIA soars, it'll say, thanks for the lovely high price. I'm going to take some profits. And so it earns a rebalancing alpha.
I see.
It gives you a stark value tilt, and it beats the value indexes relentlessly by 2.5% a year, compounded over the last 20 years since the idea was launched. So this is what we're best known for.
Okay, so I want to make sure I understand this, because I'm not an investment guru by any means, as you are. So you're sort of saying, let's take NVIDIA, because that's the classic example. Their market cap rate, I saw the other day, it's like near $5 trillion. That's incredible.
Correct.
So you're saying that their expected performance is already priced into the stock.
Yeah, their annual sales are not yet $200 billion, so they're selling at 25 times sales. Not 25 times earnings, 25 times sales. That's a stupendous multiple. And is it a wonderful company? Yes, but it's in the price, and it won't help you unless it takes that $200 billion of sales and turns it into $500 billion, then $1 trillion, then $2 trillion. It has to grow by huge margins in the years ahead in order to justify today's price. If it doesn't, it's too expensive.
So by the way, you're not saying sell NVIDIA, are you?
No, it's a wonderful company.
Right.
And it's in the top 20 in RAFI, in the fundamental index. It's one of the 20 biggest businesses in the U.S., but it's not number one, not by a long shot.
Got it. Got it. So as
that's the strategy we're best known for, and it
has worked.
Invesco and Schwab. Yeah, Invesco and Schwab and PIMCO all have RAFI-based strategies that they offer. Our business model is to develop ideas and to license them through major distribution platforms. So we have to have good ideas for them to embrace the idea, because they have R&D teams that are very capable of developing good products. So unless our products really rock, they're not going to be embraced by big organizations like Schwab or PIMCO.
That's
but
for sure.
These ideas do rock.
So how do people how do people find out more about this? Do they go to the website or Research Affiliates website?
If you go to our website, which is researchaffiliates.com, there's our ideas page where we post our research, and our products page where we post links to PIMCO and Schwab and Invesco and others who offer our products, and then you can look for the product that fits your target market. But RAFI has beat conventional cap-weighted value in investing by about 2% a year for the last 20 years.
Incredible.
And that's
a lot.
Huge.
That's a lot. Okay, so let me ask you about two investment questions that I have. One is, and these are related to policy. By the way, I think the first time you and I met, Rob, was in the office of Rand Paul, my favorite senator. I think yours too, who's a libertarian. I think. Yeah, and he's doing an amazing job. So, we want limited government, but we're seeing government continue to grow. Even under Donald Trump, it's growing, and the Republicans may cave in on this healthcare fight. So how big of a problem is this for our country?
Oh, it's a huge problem. We will have a financial crisis if we continue down this path, and it's a crisis that could dwarf the global financial crisis. You can't spend money you don't have indefinitely.
Right.
And that's what we're doing. I would say that there's more stupid ways to spend money and less stupid ways to spend money. Sending checks to people it's stupid, but it's not as stupid as sending checks to random overseas recipients or sending checks to Somali refugees running fake daycare centers.
Yes.
Sending checks to citizens who will turn around and spend the money is about the most efficient waste of money you can imagine.
Well, I would say that the best thing would do
damage.
Yeah. Yeah. Well, so as you look ahead then in 2026, we have a lot going for us. We have, lower tax rates coming. We've got, looks like, by the way, tariffs. I wanted to ask you about tariffs, because I think you and I are generally in agreement that free trade is the way to go. And what I've been saying about Trump's tariffs, and I want your reaction to this, Rob Arnott, is, that I don't like his tariffs, but I do like some of these trade deals that he's getting, where he's getting other countries, I'd say forcing other countries to either reduce their tariffs or invest more in the United States. And so my line is, I don't like the tariffs, but I like the trade deals. And I wonder what your reaction is to that.
There's a book from 2,500 years ago by a guy named Sun Tzu, a general in China, called The Art of War.
Yes.
Donald Trump studied this closely in college and has built his life on a foundation of that book. In fact, Art of the Deal was named after Art of War.
Interesting.
In that book, Sun Tzu lays a foundation for scaring your adversaries, for winning without having to fight, by deceiving your adversaries, by bullying your adversaries. Trump lives Art of War. So if you want to understand Donald Trump, read the darn book. It's a short book. It's a fast read.
Yeah. It's a great point, Rob. I mean, it really is a great point, because, in my meetings with Trump, he thinks strategically. And I'm wondering, have you read The Art of the Deal, by the way?
Oh, yeah, of course.
What do you think of that book?
It's a good book. It's not the best business book I've ever read, but it does lay out I think it's a better book for understanding Trump than for making deals, because most people don't think the way Trump does, or most people don't think of deals as war. Mm-hmm. And if you don't think of deals as war, it's not going to be a good guide for you. But if you think of deals as war, then it's got some very useful ideas in it. Bottom line is Trump plays the tariffs game to get his best deals. In 2017, he offered to the EU, you charge zero for our goods, and we charge zero for yours. Yeah, he's fine with zero tariffs, but if he wants to get you to do what he wants you to do, he's also fine imposing 100% tariffs. And boy, he's struck some interesting deals, pretty good deals. And our aggregate tariff rate, people were freaking out at the beginning of the year. They were freaking out because he was threatening big tariffs, and then Liberation Day came and he imposed huge tariffs, and everybody was convinced this would lead to a Great Depression. Pardon me, it was a negotiating stance. Yes. It's what he does. Yes. Where we've settled in is mostly around 15%. How different is a 15% tariff from a 15% value-added tax applied in a limited way to just the imports? Yep. It's the same thing. And it's a great point. Everybody freaks out about 20% VATs in Europe. So what's a 15% VAT that's limited to imports? It's well put. I think you're exactly right, Rob. And I think, having been in meetings with Trump, that's the way he thinks. And he'll say, I went in to see the Prime Minister of Japan. The first thing I said is, we're going to put a 100% tariff on you. And they, what do I have to do to stop you from doing that? Exactly. So, all right, Rob, we are out of time. Thanks so much for joining. Can I have you on? I want to have you on sometime again in the weeks to come, because you're a fountain of wisdom. And so appreciate you coming on. Have a happy new year, my friend. Have a great new year. Bye. You too. We'll be right back, folks. This is the More Money Show.
Thanks for listening to More Money with Steve Moore. You can hear More Money with Steve Moore Saturday afternoons at 1. If you like the podcast, share it with your friends and listen anytime at WABCRadio.com and download the WABC Radio app. Hit that subscribe button on all major podcast platforms. Plus, follow WABC on social on Instagram, TikTok, Facebook, and X. See you next time for a new episode, so you never have to wonder, what the heck is going on here?
Every week, the Payne family cuts straight to the real financial story.
The one question, Bob, everyone's asking is, are we in an artificial intelligence bubble? You've been through boom and bust. What do you think?
No hype, no myths. Just what actually matters to your money.
Does feel very similar to what we experienced in the 90s. Where are we, though? Are we in 1995, 1997, 1999?
Listen to the Pain Points of Wealth on the Red Apple Podcast Network.